Bitcoin options market tells you the probability that BTC will land in a certain zone by September 2026. A historical model can also compute a probability. When these two numbers diverge, it's tempting to call it a mispricing and jump on a trade. But here's the catch: the option price is not a weather forecast, it's an insurance premium. It bundles expectations, fear, capital constraints, and risk compensation. In this analysis, we dissect a real Deribit option snapshot, walk through the Q probability, the P probability, the risk premium baseline, and the executable spread structure. By the end, you'll see that the most professional output of a strategy is sometimes not an order, but the refusal to treat a raw gap as alpha. We start with two measures. Q is the risk-neutral measure, extracted from options prices. It's the pricing probability that makes all derivatives consistent with no arbitrage. In the Q world, risk preferences are compressed into the price, the focus is on internal consistency. P, on the other hand, is the physical measure, our best estimate of the real-world outcome distribution. It comes from historical returns, conditional volatility, and model assumptions. Q answers, what price is the market willing to charge to insure against a given state? P answers, how likely is that state to actually occur? So when Q is higher than P, it first tells us that insurance for that outcome is expensive. It does not automatically mean the market is wrong. We frame the strategy as an equation. For an event interval A, define the raw gap G as Q probability of A minus P probability of A. However, we cannot trade G directly. We must estimate the risk premium baseline B that the market typically charges given the options term, delta, volatility regime, skew, and liquidity conditions. The residual R equals G minus B. Only when the absolute value of R is large enough, larger than the model disagreement among P estimates, and larger than full trading costs and safety buffer, does it become a research candidate. This formula defines what we study. It does not guarantee a profitable conclusion. It forces us to ask, after accounting for normal compensation for bearing risk, is there anything left? We anchor this analysis with a real options snapshot. On July 23, 2026, at 1850 Singapore time, we captured Deribit's linear USDC settled Bitcoin options for the September 25, 2026 expiry. The spot index was approximately 65,753 USDC, with the options implied forward around 66,203 USDC. There were 64 days to expiration. The chain consisted of 120 calls and puts across 60 strike prices. We specifically chose linear USDC contracts because their payoff is directly in USDC, making the dollar-denominated terminal distribution extraction clearer. Inverse coin-margined contracts require additional adjustments for the numeraire and payoff function, don't just copy the formulas over. To get Q, we start with the volatility smile. For the same expiry, we arrange the Deribit mark volatilities by strike and interpolate them in log moneyness space using a shape-preserving spline. We then apply the black 76 formula to reconstruct a smooth call price curve. The risk-neutral density is obtained by taking the second derivative of the call price with respect to the strike, following Breeden and Litzenberger. There are two critical limits. First, differentiation amplifies noise, so we cannot directly difference raw bid-ask prices. We used 49 effective strikes, with implied volatilities ranging from about 35.8% to 86.2%. Second, the density at the tails is sensitive to extrapolation. This is a research-grade approximation, not a falsely precise decimal. Estimating P is harder. We used 3,490 daily returns from Coinbase since January 1, 2017, to simulate 64-day paths under three schemes. The first is a stationary block bootstrap that preserves short-term return clusters. The second is an EWMA conditional volatility path, allowing volatility to update with shocks. The third samples only historical starting points with 30-day volatility close to the current level, observing what happened afterwards in similar regimes. Each model generated 20,000 paths. We then took an equally weighted mixture of the three model probabilities to form our P estimate. Crucially, we did not average the curves into a single false certainty. We kept the maximum and minimum probability across models for each interval because the p-model uncertainty is often the biggest risk in the whole strategy. Now look at the results. For the September 25, 2026 expiry, we bucket the terminal price into 5 ranges. The bar chart shows Q in orange and P in blue. The widest divergence is in the 90K plus zone. Q gives about 2.7% probability, while P estimates around 14.5%, a raw gap of 11.8 percentage points. I deliberately call it a raw gap, not alpha, because this chart mixes at least 3 things: the risk premium investors are willing to pay for convexity, the estimation error of the P model, and any potential true mispricing. If you trade based purely on the distance between 2 curves, you are not doing quantitative finance, you are using a pretty chart as a trading reason. Even for the same P, a different reasonable model can give a different answer. This table shows the mixed probability for each interval, along with the minimum and maximum from the 3 component models. For instance, if the QP gap in a bin is 3 percentage points but the P models themselves disagree by 10 points, that so-called mispricing doesn't even clear the noise floor. Conversely, if Q is consistently higher than all 3 P models, and the difference is well beyond the model spread, then the signal is worth investigating further. This is the first gate: the signal must exceed estimation uncertainty. The most common quant mistake is that a model spits out a number and the analyst forgets that behind that number there's an entire confidence interval. Even if the raw residual exceeds model spread, we cannot call it mispricing yet. Bitcoin options historically charge a premium for variance risk, downside skew, jumps, and liquidity. Selling a tail where Q is much higher than P might look like capturing a premium, but it could simply be collecting small fees regularly while occasionally suffering a short, sharp drawdown. The correct approach is to maintain a historical options database and, for each combination of term, delta, volatility state, skew, and order book conditions, build a baseline B of typical Q minus P. Only when the current residual deviates from this conditional baseline, and does so consistently across multiple P models, do we get a genuine residual signal. Formula 3 states this baseline regression. Once a residual signal passes the gates, we express it using defined risk structures, not by outright selling tails. Consider a narrow vertical put spread: buy a lower strike put and sell a higher strike put, netting a credit. If the strikes are close and we divide by the strike width, it approximates a binary put, though still affected by discrete strikes and execution costs. The symmetric fly, long 1 low strike call, short 2 middle strike calls, long 1 high strike call, produces a triangular payoff and is more suitable for expressing views on a narrow price range. The formula here gives the risk boundaries, but it does not guarantee a replicable edge. The parameters, direction, and execution are left for you to verify independently. We distill the whole process into 4 gates. Gate 1, Model Gate: the QP gap must exceed the P model disagreement. Gate 2, Baseline Gate: the current residual must exceed the historical risk premium for similar term, delta, volatility, and skew conditions. Gate 3, Execution Gate: after using actual bid and ask quotes, the remaining advantage must cover commissions, slippage, and multi-leg execution risk. Gate 4, Risk Gate: the maximum loss, including event jumps and margin requirements, stays within your portfolio's loss budget. Anyone continuing this research should save their own historical options chain, fix their rules, and test out of sample whether the residual is stable. Without a conditional baseline, a single cross-sectional gap cannot be assumed to be a persistent edge. We've laid out the principles, formulas, and caveats. The minimum standard is: fix your rules before looking ahead, don't tweak by peeking. Save actual bid-ask and fees, don't assume mid-fills. Report model disagreement, don't cherry-pick P, use out-of-sample checks. The options market gives you a price list, not answers. Real alpha is the residual that survives after subtracting risk premium, model error, and trading friction. The walk-forward verification is yours to complete. Prove the residual exists first, then discuss its tradable value. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.